Welcome back to the Deep Dive. Today, we are looking at a situation in the industrial market that, frankly, feels less like a corporate turnaround and more like a total resurrection. We are looking at Hanwha Ocean. Now, if you have been following the Korean market or heavy industry at all for the last 20 years, you know the name Daewoo Shipbuilding and Marine Engineering-ASME. Just saying that acronym usually brings up images of bailouts, endless restructuring, and taxpayer money seemingly disappearing into a black hole. It was kind of known as the tax-eating zombie of the economy. For 2 decades, it was a company that, by all traditional capitalist metrics, probably shouldn't have survived. I mean, in 2016 alone, they posted a net loss of 2.7 trillion won. It was a massive financial disaster zone.
It was certainly a failed state in corporate terms, yeah. For nearly 20 years, DSME survived almost entirely on government life support. But if you look at the board today, the picture is radically different. The company has been acquired by Hanwha Group, rebranded as Hanwha Ocean, and is now sitting at a valuation of roughly 45 trillion won. The headlines are screaming about a 366% jump in operating profit. It is a massive shift in narrative. However, our job today isn't to just buy into the hype. The mission for you, the listener, and for us is to determine if this is a genuine structural change in the fundamentals or if this is just a bubble driven by the Hanwha premium. Essentially, a rebranding exercise masking the same old shipyard issues. We really need to determine if the raw numbers actually verify this story.
Exactly. And I want to challenge this narrative right out of the gate. Because when I look at the recent numbers, specifically for the fourth quarter of 2024, I see a miss. The headline says operating profit is set to hit 1.1 trillion won in 2025, which is a massive increase. But in Q4, they actually missed market expectations. Operating profit dipped. For a macro strategist looking at risk, that looks like a serious crack in the armor. It suggests that despite the fancy new name, they might still be struggling with the same old operational inefficiencies that plagued the DSME days. If this turnaround is so robust, why are they missing earnings targets right when the cycle is supposed to be turning up? Is this really potential for fundamental change, or are we just seeing some accounting magic before reality sets back in?
That is a completely fair challenge, but you really have to look at the composition of that miss. It wasn't caused by a drop in orders or an unexpected explosion in raw material costs like steel, which would point to a fundamental operational problem. That Q4 dip was almost entirely due to a one-time cost of roughly 230 billion won, and that money was paid out as management performance bonuses and wage settlements. In the industry, we call this a good cost. They didn't lose that money to inefficiency. They actively chose to distribute profits to the workforce. If you strip away that one-time 230 billion won expense, the real story emerges. The operating profit margin, or OPM, for the merchant marine sector actually hits 13%. That is the critical data point you need to watch. A 13% margin in commercial shipbuilding is not just good. It is structurally significantly higher than the single-digit margins we have seen for the entire last decade.
13% is a very specific and, frankly, very high number for a shipyard. Usually, these guys are fighting tooth and nail for 4 or 5%. But let's play devil's advocate here for a second. Shipbuilding is notoriously cyclical. You know, you can have a great year because you delivered a bunch of ships and then just starve for 3 years. How do we know this 13% isn't just a total fluke based on timing? Are they just benefiting from a temporary spike in ship prices, or have they actually changed what they're selling? Because if they're still selling the same cheap container ships and just got lucky with market pricing, that margin will evaporate as soon as the macro cycle turns. I really need to know if the backlog actually supports this kind of profitability long term.
The backlog absolutely confirms the structural shift. They have effectively severed the link to their low-cost past. Under the old state-run management, they took what we call poison chalice orders, basically cheap container ships taken on at a loss just to keep the docks busy. That practice is over. The current backlog is worth about 32.18 billion US dollars, which is roughly 42 trillion won. That represents 3.5 years of solid work already secured. But the key here is the mix. It is approximately 60% LNG carriers. These are highly complex, high-margin vessels. They have resolved the winner's curse, which is where you win the order but actually lose money building the ship by shedding that deficit-laden past. So this 13% margin is a direct reflection of a permanent portfolio shift toward high-value specialized vessels, not just a lucky quarter.
Okay, so the merchant side has been cleaned up. They aren't building cheap ships for volume anymore. They are building LNG carriers for margin. That clears the incredibly low bar of just not going bankrupt. But if I am looking at this company today, asking if there's a true structural inflection point in value, I struggle to see how a shipyard, even a really good one, justifies the kind of premium we're seeing. Shipbuilding is a heavy industry. It is dirty, it is incredibly labor-intensive, and it is slow. To justify a true re-rating, they need to be more than just a shipyard. They need to be a technology player or defense contractor. Is there actually enough meat on the bone in their defense strategy to justify looking at them through a completely different lens?
That is exactly where the identity of the company is pivoting, and it is the most crucial part of the thesis. If you're still analyzing Hanwha Ocean as a merchant shipbuilder, you are missing the larger value driver entirely. The data indicates a complete transformation into a global defense contractor, and the absolute linchpin of that strategy is their move into the United States. This isn't just about exporting ships from Korea, it is about becoming a domestic player inside the U.S. defense market. They are moving from a B2B model selling commercial ships to shipping lines to a B2G model selling critical capabilities directly to the U.S. government.
All right, and this brings us to what I call the Trojan horse strategy. Let's talk about the Philly Shipyard acquisition. Hanwha bought a shipyard in Philadelphia. Now, from a purely financial standpoint, Buying a legacy shipyard in the U.S. seems like a terrible idea. U.S. labor costs are astronomical compared to Korea, the unions are incredibly powerful, and overall efficiency is generally lower. Why would a Korean company, famous for high efficiency, buy a legacy yard in Philly? It feels like they're just buying a massive headache. Unless, of course, the yard itself isn't the real asset, but rather what the yard allows them to legally do. Is it just about getting a geographical foothold, or is there a specific regulatory lock they're trying to pick?
It is entirely about picking a regulatory lock known as the Jones Act. This century-old law requires any vessel traveling between two U.S. ports to be built in the U.S., owned by U.S. citizens, and crewed by U.S. citizens. By acquiring Philly Shipyard, Hanwha effectively bypasses this massive barrier. The Philly yard is quite literally the Trojan horse. But the real objective here isn't building commercial Jones Act tankers, it is gaining direct access to the U.S. Navy, specifically for MRO, which stands for maintenance, repair, and overhaul. The U.S. Navy has a massive fleet and a critical, well-documented shortage of domestic maintenance capacity. By owning a U.S. shipyard, Hanwha can take direct orders for U.S. Navy MRO work.
I want to drill down on that MRO aspect because, honestly, it sounds incredibly unsexy. Maintenance, repair, and overhaul. It sounds like changing the oil or scraping barnacles off a hull. Why is this the golden ticket? Usually in heavy manufacturing, the big money is in the initial sale of the asset, selling the billion-dollar destroyer. Is the maintenance market really large enough and profitable enough to move the needle for a company this size? Or is this just a way to keep the Philly workers busy while Hanwha figures out a real long-term plan? I really need to understand the economics of MRO versus traditional shipbuilding.
Think of it like a car dealership versus a specialized service center. When you sell a car, you make a margin exactly once. But when you are the only authorized service center in town, you make high margins repeatedly for the entire life of that car. MRO margins in the defense sector are typically over 20%, which is significantly higher than the margins for building new ships from scratch. It turns the business from a highly cyclical, order-driven model into a steady, high-margin cash flow model. It is exactly like owning the exclusive service center for a fleet of luxury cars.
But here's the skepticism creeping back in. The U.S. Navy is incredibly protective of its assets. They don't just hand over their advanced destroyers and submarines to foreign companies, even close allies. Why would they trust a Korean company, even one that technically owns a U.S. yard, to handle their most sensitive warships? Surely there are established American, German, or French competitors lining up for this exact same high-margin work. What does Hanwha bring to the table that actually makes the Pentagon willing to open that highly guarded door? It has to be more than just having a dry dock in Pennsylvania.
It is much more. The differentiator is what the industry calls super gap technology, specifically within their submarine program. Hanwha has developed the KSS-3 Batch 2, which is a 3,000-ton submarine equipped with a highly unique combination lithium-ion batteries and vertical launch systems. While competitors build submarines designed to float silently for a long time using outdated lead-acid batteries, Hanwha builds underwater sprinters. The lithium-ion technology allows for highly aggressive maneuvering and sustained high speeds underwater for much longer periods.
So they have a faster, more agile submarine. I get that. But technology alone doesn't always win defense contracts. Politics usually does. You mentioned German competitors earlier. Germany has been building U-boats for a century. They're arguably the gold standard in conventional subs. Why would the U.S. or its global allies pivot to a Korean sub when they could just buy German? Is there a geopolitical angle here that somehow outweighs the legacy reputation and political clout of the European shipyards?
Sovereignty is the angle. German technology almost always comes with strict export license restrictions. If a nation buys a German sub, they often need Berlin's explicit permission to deploy it in certain conflict zones or to modify its weapons. Hanwha's technology is completely homegrown. They hold all the IP. Furthermore, Hanwha Group offers a true turnkey solution. Hanwha Aerospace provides the advanced engines, Hanwha Systems provides the combat software, and Hanwha Ocean builds the hull. They can offer a complete state-of-the-art package without any third-party export restrictions. That total freedom of operation is a massive selling point for nations that are increasingly wary of geopolitical strings.
Let's zoom out for a second and look at the big picture. We have the financial turnaround on the merchant side, the Philly Shipyard acquisition for U.S. access, and this super gap submarine tech. Can you connect these dots for me? I want the overarching connection here. How do these completely disparate pieces, a yard in Philly, a lithium battery, and a global trade war, actually coalesce into a single unified thesis that justifies a structural re-rating for the company? Because right now, they just look like three separate good ideas. I want to see how they form a unified front.
I will connect them right now. It is really 5 dots that reveal the massive bigger picture. First, the U.S.-China conflict leads to heavy sanctions on Chinese shipbuilding, removing them from the board. Second, because of that, global commercial orders shift directly to Korea, giving Hanwha incredible pricing power and that 13% margin. Third, the Philly Shipyard acquisition creates a functional monopoly on U.S. Navy access for a Korean firm. They are the only ones inside the fence. Fourth, that lithium submarine tech creates a technological moat that competitors simply cannot cross because they lack the tech and the export freedom. And fifth, the result. The valuation logic shifts entirely from a cyclical shipbuilder to a long-term defense company. The absolute proof of this is the Wally Schirra MRO contract. That was the very first time the U.S. Department of Defense ever granted security clearance to a Korean firm.
That is a highly compelling bull case. But my job as a strategist is to find the risks. And there is one glaring macroeconomic issue we haven't touched on yet, and that is labor. The global shipbuilding industry is facing a massive demographic cliff. The absolute Achilles heel of this entire sector is the severe shortage of skilled welders. Young people in Korea, and certainly in the US, aren't exactly lining up to do backbreaking work in shipyards. If labor costs skyrocket due to extreme scarcity, doesn't that just eat up that lovely 13% margin you mentioned earlier? You can have all the high-margin contracts in the world, but if you don't have the hands to physically build the ships, you have a critical problem. Is this the structural flaw that breaks the whole thesis?
It is a massive structural risk, absolutely. But Hanwha is aggressively addressing it with a structural solution, AI and robotics. They have recently invested $100 million specifically in US-based AI and robotics startups. The stated goal is to raise their automation rates from the current 10 to 15% up to over 40%. This isn't just a passive financial investment. It is about actively implanting advanced robots into both the Juje and Philly yards to structurally remove that exact labor cost risk. They are betting heavily that they can automate the complex welding and assembly processes faster than the labor shortage can squeeze their operating margins.
So the overarching strategy is to essentially robot-proof the shipyard. Fair enough. Let's look at another major overhang, which is the Korea Development Bank, or KDB. They still hold about 20% of the equity in Hanwha Ocean, largely in the form of perpetual bonds left over from the bailout era. That is a massive amount of stock just hanging over the market. If KDB decides to cash out to recoup public funds, that supply flood puts a hard cap on the stock price. It acts as a massive resistance line. Investors might be very hesitant to jump in if they think a giant block sale is always looming. Is this a tightly managed situation, or is it a ticking time bomb for the valuation?
It definitely acts as a psychological resistance line for the market, but operationally, it is a very well-managed burden. Hanwha Group holds a firm 42% majority stake, so they are entirely in the driver's seat. KDB actually has very little incentive to dump their stock cheaply and crash the price because that would severely hurt their own recovery rate for those public funds. They are completely aligned with Hanwha in wanting the share price to rise steadily. It is definitely an issue to watch closely, but it is not a crisis that threatens to derail the fundamental operations of the business.
All right, one final major risk. I want to talk about the Canada submarine project. This is the absolute whale everyone in the defense sector is hunting, the CPSP, which is worth anywhere from 20 to 60 trillion won. Everyone is looking at 2026 as the massive decision year. The market narrative seems to be that Hanwha absolutely must win this contract to justify its new defense valuation. If they don't win this, if the Canadians decide to go with the Japanese or the Germans, does the whole valuation thesis collapse? Is this entire defense pivot completely dependent on winning this one specific mega deal?
No, it isn't, and that is a major misconception in the market right now. The merchant marine operating profit margin of over 10%, combined with that massive 3.5-year backlog, effectively covers the floor of the company's value. The company is highly profitable and entirely stable without the Canada deal. The Canada deal is the upside option. It is the ceiling opener. If they win it, the valuation logic goes into the stratosphere. But if they lose, the company still remains a highly solid, profitable, and growing global defense player. It is a completely asymmetric opportunity, not a basic survival requirement.
So we essentially have a company that has totally cleaned up its balance sheet, legally bought its way into the highly guarded US Navy ecosystem, and is actively automating its way out of a severe demographic labor crisis. For the listener trying to cut through all the market noise over the next 6 to 12 months, what are the specific things they should be watching? I don't want any vague industry promises. I want concrete milestones. If I am tracking this potential for fundamental change, what are the 3 absolute must-watch events that confirm this structural pivot is actually happening?
There are exactly 3 structural inflection points you need to watch to confirm this fundamental change. First, the second MRO contract. We had the Wally Shira, which proved it was possible, but we need an official announcement of a second US Navy MRO deal to prove that the high margin profit model is actually repeatable and not just a one-off political favor. Second, the Canada selection. Watch for Hanwha to be officially selected as the preferred bidder for the Canadian submarine project. That directly confirms the global defense re-rating. And third, what we call the double 10. Watch for them to maintain the merchant operating profit margin at 10% annually while simultaneously turning the special ship, the defense division, into a financial surplus to fully cover its fixed costs. If you see those 3 exact markers hit, the fundamental transformation is completely real.